Hi, my name is Tim Kachani. I am the Director of Platinum Accounting Services and a Chartered Accountant with the ACCA. What I wanted to talk to you about is savings for tax, because one of the most common reasons that I see people going down, other than trade dying, is not saving for your tax. It is one of the most common things, and that actually always contributes towards people deciding to stop. And I understand how it happens, because most people start off as PAYE. And when you're PAYE, your boss will give you a payslip. They've paid the taxes to HMRC, well, I'd hope, and you will get your net salary into your bank account, where you will handle your own finances there, which is the way it's done for most people. As a business owner, that is not the case. And you're welcome to the world of having to save for money yourself and planning yourself for it, because if you don't plan for it, no one else is going to do it. So that is where you're at. So I am here to try to explain to you how this should work for you and give you some advice and guidance as to how you can make yourself less likely to be in a bad position. The taxes that I'm going to look at in this example today are particularly VAT and corporation tax. In these examples, I always suggest to my clients to have multiple accounts. Why have multiple accounts? It's very simple, because you know that if you've moved money from your current account into a savings account, which is called VAT, for example, that actually the money in that account is not yours, because it's not yours. You're just holding on to it for the government to give it to them later on. And that is the key thing, is that people receive the money, they go, oh, I've got money, and they spend it. No, not a good idea. Until you know what you have to pay to other people that you owe money to, don't do that, because it will make you be in a bad situation. I have no problem with people spending money that's from a tax side of things. If they've got a plan and it's a well-executed plan, obviously, that's great. But doing it without a plan and not knowing, bad. Don't do that. So I'll give you an example of how you do this, and I will start off with VAT. In this example here, what I've done is I've assumed this business has 2 years worth of trading history. In this case, at least 8 VAT returns. When you're looking at these VAT returns, you want to exclude outliers. What is an outlier? An outlier is a bit of data that is abnormal and not representative of the norm. So, giving an example, let's say that you are in a business and you've just made a large purchase of machinery. And that's not something you tend to do very often. But the large purchase of machinery is going to give you a rebate in your VAT. Obviously, if you include that VAT quarter as being representative, it's not. So it's going to mean that your VAT value as a percentage in the end is going to be wrong. And that's going to be too low. When actually, really, you're better off being slightly too high. The reason why I say that is because if it's slightly too high and you've got too much money in the end, you've got a savings account and you've got extra money, which is good. If you've got way too little money there, you've got a problem, because you have to find it, right? One's painful, the other one isn't. So choose the one you find less painful. In my case, I would suggest oversaving. If you want to undersave, be my guest. But the point is also save, because I'd rather be in a place that I'm going, oh yes, here's a 10 grand tax bill. Someone goes, I've got 9.5 grand, for example, therefore they have to buy £500, rather than here's a 10 grand tax bill, £10,000 tax bill, and actually you've saved nada in the end. That is not a good place to be. Don't be in that place. That sucks. So in order to make sure you're in a better place, different account, you know that money is not yours. So in this example here, I'm going to start filling this out, and I'm going to fill this out very, very arbitrarily. So I'm going to choose random values, and the random values I've selected is a sequence of 200 and 300 in each VAT quarter, which is obviously not realistic. But you will, in your own example, be able to add in something that is representative of you. And I chose 200 and 300 deliberately because it adds up to £2,000. Nice simple maths. Each line is £1,000. Okay, so I've made my life easy. So obviously this is 2 years worth of VAT, not 1, 2. So as you've got dossiers there worth of VAT, what you need is 2 years worth of turnover. So in this magical example, I'm going to assume that the turnover in year number 1 is 10,000 and year number 2 is 10,000. Again, I'm making my maths very easy, which then adds up to £20,000. Okay, that's it there, right? So then all you do is you take this value here and divide it by that value there. Your turnover, as I said before, is a value that is your sales. So this is your sales net of VAT, and this is your total VAT, which is all of this bit here. So divide this by this, 10%, right? So what does this 10% mean? So assuming you're on cash accounting for VAT, then logically you'd only pay VAT on what you're physically paid or paying at any one point in time. So logically that means from every pound net you get paid, you should save your percentage. So whatever your percentage of that is, whatever this number turns out to be in the end, is the number that you need to be saving into that bank account, because then you know it's not your money. And then when you actually have to pay your VAT bill, you can pay it because the money's there. Or if it's not enough money, then it should be a smaller adjustment, plus or minus, which will make you in a better place, which should be great. Okay, so that's VAT. So a quick example of that one there. So looking at the next one, we will look at corporation tax. Corporation tax, I've got exactly the same kind of format. What you're looking at is what a percentage of tax basically on your income is. The more years you have of trade, the more representative of your usual percentage of tax is. Therefore, as obviously trade goes up or down, you should be able to save more or less. So here it is. I'm going to start filling this out. So I'm going to assume, like in the previous example, I'm going to choose very round values, which are not realistic, but are easy to add up. And I'm going to choose £10,000 each year, because I can add that up very easily, of corporation tax. So I've now got £40,000 worth of corporation tax. Cool, that's what I've got. 4 years worth of trade, 4 years worth of corporation tax. So exactly the same thing. So I'm going to assume that in this case it's £100,000 worth of turnover in each year. So then I'm going to add that up to be £400,000 worth of turnover. Very simple. So again, you take the smaller, the lesser of the corporation tax divided by the turnover, and that will come up with a percentage. Say, for example, in this case, if you did that in a calculator, it would come up with 0.1, which is 10%. So in this case, that would be 10%. So again, exactly the same thing. What I would suggest is that you would have a tax account, whether you have it as a corporation tax account or a VAT account or a joint account that you use for all your taxes, up to you. But more clarity is good. More knowledge is good, because it's very easy to sell yourself down the river when you don't know you're even going down the river in the first place. So in this example, you would get your sales, whatever your sales is, and you would apply 10% of what that value is and save that for your corporation tax in order to make sure that you are in a better place. Obviously, taxes change over time. They go up, they go down. You know, this happens, right? I'm not going to say it doesn't. It clearly does. So obviously, if you know outside of this that corporation tax has changed, up, down, left, right, whatever, a little bit of shake it all about, then you can adjust that value with basic knowledge, right? So if it's gone from, say, 20% to 25%, the value's increased by 25%, right? So, you know, therefore you can do the relevant increases to make sure you are in a better place. So that's Tim from Platinum Accounting Services, trying to help you have a better life by actually having more management of your finances. I hope you really enjoyed the video and it was helping you today. And if you enjoyed it, please do drop a like, share it to people that you think it would help, and subscribe for more content that will be coming forward to you to help you in your business. Well, that's it. Thank you. Bye.